Um, hey, everybody, and welcome to another in our series of webinars to keep you updated on all that is real estate in our new world. I have the great pleasure today of introducing Leslie Appleton Young, who's the Senior Vice President and Chief Economist for the California Association of Realtors. Many of you, I'm sure, are familiar with her and have seen her speak in the past. Leslie directs the activities of the association's member information team, where she oversees analysis of housing market and brokerage industry trends, broker relations, and membership development activities. She's also closely involved in the association's strategic planning efforts and is a well-known speaker in California's real estate community. She served on the State Comptroller's Council of Economic Advisors, and in 2017 was recognized as a Woman of Influence by HousingWire, prestigious honor to high-achieving women across the U.S. housing economy. Leslie is also the co-founder, along with Sara, Sutachan, of WomanUp, the national initiative to support women in real estate. While I have attended many conferences and events with Leslie, last year I had the honor of attending my first WomanUp and was absolutely inspired and moved by the entire event. I can't wait for the next one. Today, she's here to update us on the current market trends during what has been one of the most impactful years in real estate in perhaps the last 100. Leslie, welcome, and thank you so much for joining us today.
Mark, you're so welcome, and greetings everyone, and thank you for the very kind introduction. And I'm so happy that you mentioned that you attended WomanUp last year, because we adore men. You know, we need the support, we need the collaboration, and it was really just wonderful to have you there. So with that, I'm here to give you some context and some data on how we're doing with just an unprecedented time in so many ways. You know, this has really been a experience where I think we've all had to accelerate adaptation and change, and we've certainly done that in the research and economics area, where we've had to start looking at more timely data, more polling, more, you know, we're doing weekly surveys, we're looking at MLS data from around the state on actually a daily basis, so I'll be able to share some of that with you. I also want to do a shout out to Patrick Carlisle, who for years and years has compiled reports for the San Francisco area and that have been very helpful to us, along with others in San Francisco. So thank you for that. So with that, I'm going to go through my deck, and I will stay on for Q&A, and happy to provide additional data or information, you know, as needed. The first slide, though, is an interesting one. I mentioned that we're doing weekly surveys, and one of the questions that we asked for a couple of weeks was, what worries you more, that we're going to take too long to move on from shelter in place, or we're going to move too fast, or we don't know? And the fact that these responses are pretty much a third, I just present that as a way of saying there is no consensus in our country and there's no consensus in our industry about COVID. And to just have a little empathy and respect for each other. I've met people that think it is a 100% hoax, and I've met people who are not stepping outside their home until there's a vaccine, right? So, and we've got every gradation in between. So there's a lot of diversity. It's not a bad thing. Just recognize that we've got people with different opinions. So let's talk first of all about the economy. And I think the best way to describe what's going on is not to think of it as a more typical recession, where there's a gradual shift to lower growth, and then, you know, the economy kind of works its way out of it. When we look back at the Great Recession of 2007, 8, 9, and 10, that certainly was the experience, and it kind of promulgated, if you will, in the housing sector and the mortgage finance arena. This time around, we came into 2020 and we were doing absolutely great. We were up 8% year over year statewide in terms of the median home price. The high end of the market throughout the state had really started to show some strength that carried over from the fourth quarter of 2019. I'm actually going to be retiring from C.A.R. at the end of this year, and I was so excited about, wow, this is going to be wonderful. We are just going to end this career here on a high note, and then boom, everything changed. And so the way I would think about it is we hit the pause button. The economy was just literally stopped, almost dead in its tracks, and it happened in the middle of March. So when you look at March data, you've got 2 weeks of a normal things are going, and 2 weeks where it's not. And when you look at the real estate industry, the bottom was pretty much in every variable you look at in the middle of April, and we've been coming back since then, a little bit by fits and starts, but that's what the cycle has looked like. Just a few of the macro numbers for you to be aware of. The second quarter GDP number was revised to a minus 5%, and you can just see how that compares with the prior 15 years of experience. We are expecting a 30 to 35% quarter to quarter drop in the second quarter. And here's kind of what is an overlay to my entire presentation. There is just a tremendous amount of uncertainty. We have never had so much uncertainty that I remember in all the years that I have been doing this. This is a look at the forecast for, and we almost should call it a projection, right? We're now almost halfway through it, but a projection for what the second, third, and fourth quarter are going to look like from top financial institution, government entities, academic institutions. And what you see as you look at their forecasts, their quarterly forecasts, is nobody's got the same number, but everybody's got the same cycle. Everybody's got the same pattern, with the big hit being in the second quarter. That's, April, May, and June, and then bouncing. I will say bouncing, and then a recovery in the third quarter and in the fourth quarter. So the annual drop, if you will, is ranging between about a 5 and a 10% decline for the year as a whole. So no consensus on single point numbers, but a forecast that has the same cycle. And please understand, this is predicated on no second wave, and certainly no second wave accompanied by further lockdown, or going backwards in terms of a lockdown. It's predicated on going through the phases, phase 2, 3, and 4 to reopen the economy. And that, in a nutshell, is what the future is really tied on. It's what's going to happen to this virus, right? And that's, again, the question that no one can answer. We do know that the impact has been brutal, right? California, during the full shutdown, was losing almost a third of its GDP on a daily basis. So that's big. The unemployment rate just plummeted in the first part of the year. It recovered a little bit in May. That was encouraging news. It was unexpected, but we are still in a very, very tough situation in terms of the labor force. Last week, jobless claims came in at the lowest level we've seen since March, but it was still 1.5 million people. So we have got a trajectory that, again, is improving, but you look at the cumulative number, it's now over 40 million people, actually 44 million Americans. And this has happened in a 12-week period. Back in the Great Recession, it took 2 years for that number to reach 37 million. So just the rapidity with which this has happened has been absolutely stunning. And then here's a look at the data for California. And as I'm sure you're all aware, this is not impacting people equally, but really hitting very hard the moderate and lower income, minimum wage, diverse segments of the market, of the labor force, where they are, in restaurants and in hospitals and interacting with people on a constant basis. If you're able to work from home in an office, it's probably not been a bad, a thing. In fact, I think many people are finding it a very positive thing, but that is not the entire labor force by any stretch of the imagination. So many remained unemployed in our state. Now, one of the things I get questions about is what's going on with the stock market if the data on the economy is so negative and volatile. So just always remember that the stock market is not the economy. It's not even the measure of the health of the economy. It is essentially investors' bets on what the future is going to look like. So you have the S&P dropping 35%, and then you have it recovering very sharply as we went into April and May, and that's because investors are buoyed. They have an optimistic outlook when the Fed does what it has been doing, which is saying we are here to provide liquidity wherever and whenever we can, or there's a vaccine and it's actually going to be available sooner than you think it is. I mean, they're grabbing on to positive news. And I think the feeling is, especially given the correction we had last week, maybe a little bit overstating that optimism. Another aspect is that we are seeing stronger growth in the tech sector. So when you look at the NASDAQ, that index is much better because that sector of the economy has really, if only we'd known that we would be living our life on Zoom a few months ago, right? We might have made different investment decisions, but we are, Zoom has become an integral part of the work environment. And when we're home, we are streaming on various platforms. So it's been a very different world. How are consumers feeling, right? We always want to look at consumer confidence and kind of take the pulse of consumers. And I would say the good news here is the sharp drop that we had in March and April has stopped. Things were pretty steady in May. And my guess is when we see the number for this month, it's also going to show some improvement. So there is a return to optimism. And I know that you're seeing this in the real estate market. I know you're seeing this on the housing side. When you look at the demand side of the equation in California, it's very encouraging, right? I think the COVID impact on the buy side has pretty much been worked through. It's the sell side that in fact, someone said something that really rang true for me. Think of May and June as January of a normal year. And you know what that's like. Buyers are ready to go and sellers are still kind of thinking about when they want to do it and what repairs and changes they want to make before they put their home on the market. So really looking at the sell side, because with rates at, we've said this before, but really historic lows, the affordability measures look very attractive, and buyers know that. And again, these are going to be buyers that are a little bit bulletproof in terms of their income, right? They don't have the income insecurity that many in the labor force do right now. So I'm very bullish on the real estate market as I look at the kind of overall landscape. A few more things about consumers. We also just this morning had the retail sales report for May. We had a 17.7% increase in retail sales in May. Here's a little bit, here's another way of looking at that. You can see The March data was down, the April data was really down, and then look at the bounce back up that we had in the June data. And then here is kind of a breakout by category. So I've been talking a lot about the poor clothing and accessories area, right? They dropped about 75% between April and May, and they are gradually coming back up, with yoga pants and sweatshirts doing pretty well, right? As we kind of changed what we're wearing on the bottom, bottom anyway. Here's clothing and accessories up right here. So autos back, bars and restaurants again between April and May showing some improvement. So the trend upward that you're seeing in the economy is directly tied to the shelter in place orders, what phase you're in, and how comfortable consumers are going out. And that, again, depends on the consumer, right? We are seeing, just like we saw in that initial survey report from C.A.R. members, that there's mixed feelings about it. So really interesting. Just a few other, slides. Airlines hit very hard. Scheduled flights dropped 95%. Hotel vacancy rates. So the hospitality sector of the economy again hit very hard. Entertainment, people not going to theaters are closed, and people doing a lot of streaming. So this is one of the things that's really fascinating to read right now, because nobody knows, but how much of the changes in consumer behavior that we're seeing today, for example, online retail has grown 150%. In fact, someone said in the podcast I listened to this morning that in 3 years, you've seen more adaptation to retail purchasing than you saw in the prior 3 years. And some of that is going to stick, right? The convenience of buying that way is going to be continue to be with us. So I don't know what to tell you in terms of what exactly it's going to look like, but my hope is that we will continue with phase 3 and phase 4 when it's safe, and that the economy will continue to bounce back, if you will, because really that's the only thing that's holding it back, right, is the shelter in place and the consumer comfort with being out. Now I want to, again, I'll get to the housing market in just a minute. I just wanted to talk a little bit about the government's response to this, like what has happened, what will happen, and how does this compare with the response during the Great Recession. And I will tell you that the response was very, very rapid. In the first month, in March, we actually had 3 bills passed, the largest one being obviously the CARES Act that was signed by the president on March 27th. And then within a month, we had an additional stipend, an additional over $300 billion going into the Paycheck Protection Program. And then there's been another bill that's been passed by the House for more support, which will be hotly debated. But to date, well over $2.3 trillion has been provided to the economy. Has it been perfect? Absolutely not. There have been bottlenecks. There have been people that have purchased money, that have gotten support that probably shouldn't have, this program was designed for small businesses. It wasn't designed for Wall Street. But all that being said, it really has provided a safety net. The big debate going forward is when things start to expire, like the additional $600 in unemployment relief a week that people are receiving at the end of July, what is that going to look like? But if you go back to the Great Recession, I don't know if you remember, but I sure do, how difficult it was to get a package together. And all told, it was almost $800 billion. and it was kind of done begrudgingly a little bit. So we've learned to fight the last war, and I think that's really helped us out. I'm talking about the payroll protection program. I thought you'd like to see the cash buffer. Why the small businesses? They're so critical to our the health of our economy. And in restaurants, on average they've got about 16 days of cash cushion. That's it. I love seeing real estate at the other end of the spectrum, but there just isn't a lot of runway there before these companies go out of business. So the whole philosophy has been, let's reduce the breakage in the economy. Let's keep people from being fired and businesses from going out of, shutting down. Let's keep them afloat until we can get back to business. One of the things the CARES Act did is that for any mortgage that either had an explicit or an implicit government guarantee, you could get up to a year's worth of forbearance on your mortgage. And a lot of people applied that are still making their payments, right? It was a little bit of a insurance policy because nobody knows what's going to happen. So there are now between 4 and 5 million mortgages in the country that are in forbearance. And of course, the hope is that once that period is over, they will be in a position to pick up where they left off. And the other good news is there's been just a huge decline. There was a big push initially to apply, and now it's really become a trickle. So again, if we can get the economy going again, we should be in pretty good shape. What about the Fed? I don't think you can fault the Fed at all. And Powell has been, and I know he's probably testifying right now on, well, not on Capitol Hill, but to the Congress. They have been front and center. They always provide forward guidance. They are providing a forward guidance that essentially said, we're not going to raise rates till 2022. They never do that. They are also buying securities. They are buying mortgage-backed securities. They are buying municipal securities. They are buying securities from individual corporations. That just happened last week. They are relaxing regulations. They are doing everything they can to keep liquidity in the market, to give the business sector the cash it needs to stay in business and keep people employed. Rates, as I mentioned, absolutely at all-time historic lows. When that mortgage rate hit 3.15%, I had to do a double take. Are my glasses too? Am I not reading this? Am I not reading this correctly? So when you look at real estate in the post-COVID world, this is just an incredible boost for our industry, and to have such a long time frame where we can count on lower rates. And here's again a look at the fund rates. And I do think there is room for compression. I think there is room for rates actually to go even lower. Some of the forecasts have rates going into the twos. So, once that risk premium gets a little bit softer, we might see that. But just a wonderful thing for our industry. We have seen mortgage. Now, these are mortgage applications for new mortgages, not refinance. Year over year, we're up now. We're up 5.5%. In California in terms of mortgage applications. So that's a good sign of the health of the industry. So this is the second week in a row that we have exceeded last year. So we might not get a V-shaped recovery. In fact, I don't think we will in the overall economy, but you're certainly seeing that in terms of new originations in the mortgage market. Now, just a couple of other things. You're probably well aware of this, but we've seen a tightening in terms of credit. So the rates are very attractive. But if you are looking at jumbo financing, which certainly for the state as a whole, 20% of our originations are jumbo. For San Francisco, it's much, much higher because your median home price is about 3 times what the statewide median is. So the problem here is investors have no appetite for risk. And if the Fed can't provide a guarantee and if Fannie and Freddie can't provide a guarantee, they're just not interested unless there's no risk, right? So one of the surveys that we did was asking realtors for their comments on this. And one of them was, we were all good to go. And then at the last minute, my buyer, a 20% down wasn't good enough. It had to be 40% down. They didn't have it. They weren't able to get the loan. So all kinds of requirements are being put in place just because those investors are really, fleeing to safety. So in our weekly poll, we asked realtors, have you had a buyer who lost their down payment? Last week, 14% said, yes, I have. And then we asked if changes in credit requirements had affected the qualification of their buyer, and 29% in the latest week of the realtor said they had a buyer in that position. So that's just one more hurdle. So again, I'm not going to read all this, but I think the important thing to remember about real estate is it looks like we will be one, if not the leading sector coming out of this in terms of the recovery. We won't be lagging. We will be leading, and I think that's something to be very cognizant of, and it's certainly very reassuring for me. We do a monthly survey on Google and ask consumers in California, is it a good time to buy? Is it a good time to sell? And about a third today in our June data said 32% said it's a good time to buy. So this is higher than we had pre-COVID. And it's to my point earlier, the buy side is not the side that we're troubled with. We've got a strong demand for housing in California. We are limited in terms of supply. We've talked about that for years. Is it a good time to sell? What's encouraging here is after a huge drop between March and April, by June, we were back up to 40%. Now we want to get up closer to, 55, 60, but we're moving in the right direction, right? So things are a little bit more optimistic there on the sell side. And here you can see the way those two curves came together in April with just the COVID surprise, right? And then kind of starting to recover. The other data, I don't know if you've seen this from showing time, but we are now looking at showings exceeding the same period, the same week in 2019. So that I think is worth noting as well. So lucky for all of you and for me, although I know you've probably seen the May data a few days earlier, but we put out our press release today on our May numbers. So I'm happy to share those with you. And as expected, on a year-over-year basis, we had a drop in sales of 41.4%. Again, this is about what we expected. It's actually a little bit better. Our highest estimate based on looking at pendings was about a 47% drop. So year to date, we're off about 13%. In terms of pricing, we started to see prices soften. We had a 3.7% drop in the statewide median. There are a variety of things going on here. Some of it is regional. Some of it is fewer sales at the high end. So composition explains part of it, but there's also a general, very moderate softening going on that's showing up here. And I'm not troubled by this. I think the price trajectory for California looks very, very positive. Now, I learned during the Great Recession to never say never about anything. But as I look at this robust demand, as I look at a projection for a slow, uneven, but continued improvement in the economy as we loosen up, I think on the price side, we are looking at some pretty firm prices and a return to appreciation, maybe even later in the year, but certainly next year. And I'm comparing this with a 60% drop in the statewide median that we had during the Great Recession. Here's kind of a 15 years of closed escrows in California. You can see the Great Recession. You can see that V-shaped recovery going into 2009. And then, and I mention this every time I speak to you, we're looking at a very long period where we are fluctuating within a narrow band at a time when we have great rates, we have household formation, we have an expanding economy, we have income growth. And what's really restrained the California market are the twin breaks of affordability and lack of supply, right? So I've said this for a couple of years. We're 20 to 25% below the transaction level we should be at, given the fundamentals in the market, but we just simply have not had the supply. Here's a look at that big drop that we had in May, the biggest drop since 2007. Here is a breakout of sales by region. The San Francisco Bay Area makes up 17% of the total sales in California, and they, along with the Central Coast, had a drop of a little bit over 50% on a year-over-year basis. Here's that trajectory for the Bay Area, and then here's San Francisco with a 55.6% drop in terms of that year-over-year change. So I know this is no surprise. We were expecting it. Just remember that this data is looking in the rearview mirror, right? These were all transactions that went into escrow 6 to 8 weeks ago. So it's old news. It's news, but it's old news. So that's one of the things that you need to explain when you're meeting with clients. The biggest drop year over year in sales was at the upper end of the market. So for properties priced over $1 million, properties priced over $2 million, there was the biggest pullback in the rarefied air of the more expensive housing, but everybody moved in the same direction. And that's really been an interesting thing as we've gone through this. Typically different parts of the state, react differently. And the Bay Area, even though they went into shelter in place before anybody else, they've also, in terms of their economy, been more insulated than, let's say, Southern California, where the entertainment industry has been really hit very hard. But in the Bay Area, the tech sector has not, right? There's not been big layoffs announced. There may be moving to different parts of the country, but they have really been the winners in this particular cycle. We also saw in our May numbers that pending sales increased 67%, huge increase in pendings. So this is looking today at the transactions over the last month that have gone into escrow, and that's how responsive this market is when it's allowed to perform, if you will. So here you can see just talk about a V. This is a V-shaped recovery when you look at the pending sales numbers, and particularly at the high end of the market that pulled back the most. They have had the biggest 25% bounce back for properties priced over $3 million. So I know there's a lot of you that are looking at your business at the upper end in San Francisco. So that again is very encouraging. I've talked about prices already. I've talked about being relatively confident that we are not going to see significant declines in prices. Again, I want to say I will never say never. You can tell scenarios that get you anywhere you want to go, but just looking at the data right now in terms of the demand side coupled with the low level of inventory, I just don't see it. And I'm going to show you some slides that give a little bit more info on that as well. Here's San Francisco. The median in May was 1.627 million, down 4.1% on a year-over-year basis. So not a big change there. Here's a look at price per square foot, and again, we like to look at the market from all the different angles. So that's down 3.8% on a year-over-year basis. So you know that the data that we're looking at is not being impacted by a change in what's selling, because you kind of get rid of that when you look at price per square foot. So that's down about what we're seeing in terms of the median price. Here's a look at the sales to list price ratio, and in May 2020, it's at 99.7, so very close to 100. So that's maintaining. You know, you're not seeing a lot of discounting there. Here's a look at the trend over time in listing price and sales price, and what we're seeing in the May data is a big uptick in listing prices. Right, sales prices had been going down a little bit, but they tend to follow the list prices. So that's why we're a little more bullish as we look out the next couple of months in terms of prices. I mentioned kind of the role that lower rates play in housing affordability. We have had a 13% decline year over year in mortgage payments, just because of that drop in interest rates. Here's another look at the decline in mortgage payments. So that, again, despite everything, that's always really good news, right? A year ago, for the median priced home, you were paying $2,350 a month. Today, it's $2,040. That's real money, right? That's a significant savings. So what about inventory? That's kind of what it all depends on, right? What's going on with inventory? Well, what we had happening in May was we had fewer sales and we had fewer new listings, right? But the sales drop was bigger than the drop in listings. So when you look at the ratio of listings to sales, it actually ticked up, right? So a year ago, we had a 3.2 month supply of homes on the market. This May, we had a 4.3 month supply of homes on the market, which for the state as a whole is a little bit higher than we're used to seeing. The new normal has been around 3. So again, this index is a ratio of listings to sales. So 4.3 just says at the current rate property is selling, I'll be out of inventory in 4.3 months. Here's a look at San Francisco. And San Francisco, again, showing kind of an exaggerated trend. A year ago in May, there was a 1.5 month supply. In May of this year, there was a 3.7 month supply. So sales dropped, listings dropped, sales dropped a lot more. So 3.7 is higher than we've seen in San Francisco for a while. And I will say, I don't think that's a bad thing, right? There's more to look at, and you have a strong demand side. Active listings dropped 34% statewide in May, and kind of reversed a trend where the prior 3 months the decline had been pretty flat. So that is also kind of heating up the market, because there's really less to look at today than there was a year ago. In San Francisco last May, you had over 8,000 listings. This May, you had 5,846. And then if you look at listings compared to sales, here you can see what I mean. Active listings in San Francisco were down 27%, but sales were down 51%. So that's why you have the increase in the index up to 4.3. So more of a supply, if you will. But one thing, again, we keep talking about the luxury market, and that's very relevant to San Francisco because with a median home price of 1.67, you have a very distinct and very high-end luxury market, right, compared to other parts of the state. And for the 3 million and above properties, you actually had an increase, right? You had an increase in inventory in May. So good job to all of you that are making that, going out and making that that happen, because it's showing up in our data. Now, there is an expectation in the market that prices are going to be lower. And we've been tracking this for weeks now. When we ask realtors, are your buyers expecting lower prices? What we're not seeing is a response on the supply side from the sellers. When we look at share of listings with a reduced price, that actually is lower than it was a year ago. It's 5% lower. So we're not seeing any kind of a fire sale thing at all, right? We are seeing really not aggressive discounting at all, not very little discounting. In fact, it looks like the normal amount than in COVID. So just a couple other data points. I hope I'm not losing you here. But I mentioned that we've had to do different things at C.A.R. And one of the things we're doing is looking at the MLS data on a daily basis, and we're calculating average daily closed sales, pendings, and new listings for the last week. So this is data that I actually just got an hour before I began speaking. So this is data through June 12th. And again, we're looking at incremental changes because we just can't afford to wait for a whole month of data. You know, who cares then? It's rear view mirror. We want to get a feeling for what's happening now. So you can see here in the Bay Area, and again, you can see how different parts of the state are. So Bay Area up just a little bit, state as a whole down just a little bit. So here are the percentage changes. So Bay Area closings last week were up 2.4%. For the state as a whole, they were down 2.3%. So hence the value of the local data that you bring. Your district data, right, is absolutely gold. What about pendings? Right, pendings up in the Bay Area, up statewide as a whole, they were up 12.3%. For the Bay Area, 5.1% for California. And what about new listings? New listings were down pretty much across the board, down 3.4% in the Bay Area, down 9.5% in California. I'm not going to go through county by county data because it's just too many data points and it gets too monotonous, but I will tell you that there is a shift to the outlying areas, if you will. And if you look at the data for Napa, you look at the data for Sonoma, you look at the data for Marin, they're a very different market right now from what's going on in San Francisco. And part of that is escaping from the city. Part of that is working from home means I can work from anywhere. Part of that means I can't travel with my family this summer, so let me get a house. I mean, this is obviously rarefied air, but it's really showing up in those markets, right? It's also maybe a flight to safety where less density and more open space means a lot more to people in a pandemic situation. So you've got kind of a spreading out, if you will, to the fringes. So again, the value of the local data. We're also doing a weekly poll of members, and I just brought a few slides here. If I'm losing you, we're asking, have stay-at-home orders loosened up for you? Is it making it easier for you to show property, occupied property? So about 2/3, 68% said yes, things are loosening up, and 3/4 of them have said there's more activity, and about half are saying there's more calls from buyers to look. So that's a pretty strong support for the argument I've been making about the change in the market. And we asked, how quickly will you resume showing property? And last week, 52% said, I'm already doing it, right? And the others said, immediately after the orders are relaxed, because again, it depends on what area of the state you're in. So the real estate community is ready to go safely when it's safe to do so. We asked, have any of your sellers reduced the price of their home? And 2 out of 5, 21% said last week that they did. We also asked them which part of the market has been the most impacted. And not a lot of difference, but luxury homes, not surprisingly, had the greatest percentage at 39%, saying the most impacted. What type of buyer? First-time buyers, right? And these are the first-time buyers with more fragile incomes would be my assumption. Just a few other things that are really interesting. Last week, 10% of the realtors said they had a buyer put a home into contract without seeing the home in person. So there have been a lot of questions about how can you really do a virtual transaction? Well, it's not for everybody, but there's some of that going on. We asked, again, there's been a huge trend to vacant properties, right? Because you don't have to worry about all the rules and regs when it's a vacant property. So almost half said they have a vacant listing, and 37% said they actually did it in order to facilitate showing, and most of them are showing those properties. We also wanted to know, is it taking longer to close? For about half the people, yes, and for about half the people, no. So very different local rules and regulations and ease being experienced. Were the home buyers you interacted with expecting lower prices? 2/3 of the realtors said yes, they were. 11% said they had a buyer attempt to renegotiate the price when they were already in escrow. So I have a zillion more slides. I'm not going to bore you with them, but I wanted you to have a feel for, kind of the diversity of the experience, the common themes, and just how it's just absolutely fascinating to watch. And certainly I'm feeling a lot more positive now as I'm seeing us having well turned the corner. A lot of debate about what letter of the alphabet this recovery is going to look like. I think the V is pretty much not happening. I'm more in the swoosh category, rapid drop and a gradual recovery. And I think that's what we're seeing happen, although I think real estate is going to be a much faster recovery than other parts of the industry. And again, that strong demand side, limited supply, and low rate environment. So it's going to take some time, but I just don't think there's any way around that conclusion. Now, I wanted to share a couple of forecasts with you. This is from NAR in blue, Fannie in orange, and the MBA in green, showing you kind of the second quarter drop and the recovery in the third, fourth quarter and into the second half of the year. So a similar trend, but a different speed of recovery. Here's what those percentage changes look like. And I'll just highlight, I think Lawrence has really done an excellent job with the NAR forecast. So he's seeing for the second quarter nationally a big drop, 41.6%, and then a strong turnaround in the third quarter. What about prices? I think what you take away from looking at the trajectory of prices through the middle of next year is there's some softening, but not significant, and not looking anything like what we went through in the Great Recession. For NAR, they're actually seeing positive in the second quarter, negative in the third and the fourth, and back to positive next year, but all within a band of 3.5% up and 3% down. So a fairly narrow band in terms of the price behavior. And then here, if you want to look at it later, are all the actual changes. And this is where we are at C.A.R. We're doing a couple of different scenarios based on the assumption of the continued relaxation through the phases of the economy. And we are revisiting this forecast every month. Right now, this is the one that was done at the end of last month, at the end of May. We're looking at a sales decline of 12.7% for the year. A month earlier, it was almost 17%, so moving more positive as we speak. And our forecast for prices was originally a drop of about 3%. This is a drop for the year as a whole of 1.1%. So outperforming what our original, and again, there was a lot of uncertainty and fear. You know, if you go back six weeks ago, I think we all have a better handle on what's happening today. I also thought you might be interested in looking at membership in the California Association of Realtors, because that's been kind of interesting too. And these are slides that were shared with the board of directors at the meeting that we had in April. So this is a slide of sales and memberships in blue, and it's the scale on your right. Sales are in that teal color with the scale on your left. And I put them together just so you could see, you know, sales peaked in the late 70s, 2 years later, membership peaked. Sales peaked in the late 80s, and 2 years later, membership peaked. But when you look at the last 4 or 5 years, you can see a little bit of a disconnect. We kept gaining members when sales were flat, right? So the volume was going up, but the number of transactions was pretty flat. As we look ahead, one of the things that we're aware of, obviously, is that the pipeline has gotten much smaller in terms of people that are passing their tests, right? Their brokers and salespersons test at the DRE. So as the DRE kind of quit doing exams and so on, you can see here's broker licenses. So we still had some being issued in April, but not a lot. And then look at this big reduction for salespersons licenses in April, only 820, about a 50% drop from a year ago. So our forecast as we look at 2020 is for a total membership of 196,200. Our original forecast for this year was 205,000. So we are taking the hit on the new members because most of the renewing members come in January and February. So it's the new members through the rest of this year that are pushing that number down by 5.2%. And then in 2021, a drop of 8.3%, which is not as big as what we had originally thought. But again, what we're seeing in terms of the new members is the lowest number of new members that we've had in over 20 years. So that's, you know, kind of what we're preparing for at C.A.R. And I know from a personal point of view, you are probably feeling like the fewer realtors, the better. So I just want to assure all of you that we may have around 200,000 realtors in California, but many of them are not productive. That is not your competition, right? That number. So tremendous diversity. So what's next? So you may have seen this on Twitter last month. Someone said, "Show me your home office," and this is what they looked like, right? I just got such a kick out of it because I think it illustrates one of the points I want to make about the demand for housing going forward, and another source of optimism. More people are going to be working from home. They are going to need to take their existing home and either switch it out or switch it out, you know, and move, because many of them are just not set up to have a home office, right? When you look at the world today of work from home or work from anywhere, it is a whole new world. You know, you're not just living in your house, leaving for work in the morning, coming home and having dinner, sleeping and repeating, right? The home is now your office. It's your bedroom and it's your office, it's your gym, it's your school, it's your restaurant. And more, I think we will see the trend in multi-generational households accelerate as well. So this demands different types of housing. And work from anywhere means you can work from anywhere. And we're seeing that. There was an article in the New York Times this morning about New Yorkers looking at up the Hudson River, right? At those communities in the Bay Area. We've been seeing it. This is an acceleration of a trend that we've already been seeing, with people moving further out when they're able. The Central Coast, right, has been booming because of LA and San Francisco people that can really work from anywhere, want to stay in California. What a great decision that is. I think the desire for more open space and less density will propel some people to do something different. We have also been tracking migration trends out of California, that net domestic migration. That will be and is accelerating. I also think you're going to see people taking their vacations closer to home, less Europe and more Lake Tahoe, as an example, again, just for safety. For years, we've seen a shift, again, not everybody, but more and more people, it's less about the thing and more about the feeling, you know, more about the experience and less about consumer goods. I think we will see more of that shift to online selling. But just take away from this that all of this benefits housing, right? Housing is where you've been stuck for the last 12 weeks. And it's really got to deliver, right, in a world where you are there an awful lot. So in sum, I would say the winners coming out of this is our industry. It's residential real estate for all of the reasons I've already enumerated. The tech-enabled agent, and you know, we've seen this at C.A.R. with our staff. The next gen of leaders at C.A.R. has been able to step up because they have the tools at their fingertips to create dashboards and call centers and all of these things that we need. They're digital natives, and it's been a beautiful thing. And you're seeing that in the real estate industry, right, with people that are comfortable doing virtual tours and virtual closings, have just had a much easier time than people that are still trying to figure out their keyboard. The relationship-centered agent, we do a lot of talking about relationships, but I will tell you that the number one complaint from consumers, or one of them, is, I never heard from my agent after the close. This pandemic is a gift. It is an opportunity to contact everyone and just ask how they're doing, right? To just connect on a true emotional, human-to-human level. And then finally, I think this could be a huge win for housing. And I mean, when you look at the commercial and retail sector that are going to have vacancies because consumer behavior has changed, what an opportunity to transition to housing, to take an empty mall and turn it into senior housing, affordable housing, homeless housing, plenty of parking, create a village. I hope that we can, you know, I know there will be a lot of barriers to implementing, but you know, you find in California that it's the neighborhood groups that are killing new development. Well, how about taking maybe an eyesore and turning it into a beautiful residential park? I hope we don't really miss that opportunity. So in closing, my history is always to try to leave you with a couple of books. And these aren't books that are new. They're books that over my career have really changed me, made me a better person. We Need to Talk is just a wonderful book about how to listen. how to not hijack a conversation, how to just be in the moment. And I can't think of anything more important for a realtor to know how to do that, right? And I it's just great. Humans are underrated, you know, as we get into a more and more technical, digitized world. What humans bring to the table is more valuable than ever. And then crucial conversations, you know, the ones you don't want to have are always the most important. So those are just a couple of suggestions. And then finally, I just want to show you, I know a lot of you have never been to CAR.org except for zip form, and that's fine. But I do want to tell you, under the CAR.org, under Industry 360, there's a market data tab that has so much. It has all of our stuff. It has the data and statistics. It has our bi-weekly podcast. It has a weekly summary of what happened in the economy that you need to care about. We have shareable and interactive reports where you can drill down by price category or zip code or city and create in about 3 seconds, because they're already created, a shareable infographic on for Instagram. You know, it's incredible. Every speech that we do is posted as both a PDF and a PowerPoint. So if you want to steal slides, you can do that. And then we have a lot of reports. So it's just a very deep well for anybody that might be interested. So with that, Mark, I hope I haven't put everybody to sleep, but that's what I've got. And I want to thank everyone for having me, and I'm happy to try to answer any questions.
Well, I'm gonna let Genevieve handle the questions, but I do want to say this has been an amazing presentation, and we're so fortunate to have had you this morning to ourselves. So we really appreciate it. So
Thanks,
thank
Mark.
you.
Hi, Donna. So many friends here.
Jen, are you taking it away there?
Yeah.
There
Hi,
she
guys.
is. There she is. There she
I'm
is.
here. Okay, so the first question that's come through is, what do you think about SF or LA single family or apartment markets?
Oh boy, that's kind of a tough one. I think it's a very tough environment to be a landlord, particularly a small landlord in California today. There's no easy way to evict people. There is a moratorium on paying and so on. So I'm really not exactly sure what to say. I don't think it's a good environment right now in California. Clearly the demand is there, right? There is such an unmet demand on the part of households that can't afford to get into housing. But from the investment perspective, I just would be a little bit wary, certainly during this period of time where you just don't have any guarantee of a steady rent payments going forward. So that's a really a tough one, unfortunately. And then you've had rent control on top of that, right? Which you guys all, now it's statewide. So
Okay. Next question is from Gavin Schock. What do you think about the impact of Proposition CA Assembly Member David Chu proposes to ban evictions for renters who are affected by COVID-19?
yeah, I think I just answered that, right? It makes it a very hostile environment if you own rental property. And I think that's the bill where originally there was like a 25% reduction in rent. I don't know if that was the one or not, right? There have been quite a few like that. So that's just another example. And I'm not at all saying that renters don't need help and support, but to provide it on the backs of small business owners, i.e. the mom and pop, landlord is really not fair. Let me just say that it's not fair.
Okay. Let's see. What is your What is your forecast for price growth in San Francisco homes in various price groups, particularly particularly high price homes, 3 million and 6 million going forward over the next couple of years?
Well, I don't have one. I can tell you that that part of the market has been softer in terms of prices, and you saw that in the data that I presented. When you're looking at $6 million homes, it's a very small sample, and it's very rarefied air. So I would not expect to see any significant appreciation there. But we just, we don't. It's very difficult to do any kind of a meaningful forecast as far as that goes. But when you look at the data that we do have broken out by price category, you've had a strong rebound in terms of listings. But my guess is some of those are kind of overshooting the market, if you will, and there's going to be some adjustments coming down. But again, you get above 6 million, you just don't have enough data points to do a forecast for everybody. They're all kind of one-off. So I apologize for not being able to be very helpful on that. And if you meet someone who is able to do that, please have them contact me, because I would like to discuss it. To discuss it with them. And just in general, we so much stronger price appreciation is where the market is the deepest, right? And that's in the more moderate and entry level. So in San Francisco, that's kind of anything above maybe 1.5 million and below, right, at the median and below.
Okay, thank you. Next question is, many clients are worried about the upcoming presidential elections. How do you think that will affect us?
Typically, again, we get asked this question every election cycle, and we've got, 35 years of data looking at the housing market and the elections. And typically during an election year, the market pulls back a little bit. I mean, it's not even significant, but you can see a little bit of a pullback in the quarter leading up to the election, and then putting it back in right after the election. So it doesn't seem to be who's elected. It's just the uncertainty about who's elected causes people to be a little more cautious, a little bit more uncertain, a little bit more likely to pull back on their plans. And then once the election is over, they go forward with their plans. So you kind of build it back in after the election. So we don't see a difference whether it's a Democrat or a Republican. And again, I'm just looking at a long-term period of data. It's really the uncertainty about the outcome, not the actual outcome itself, that seems to be impacting the market. And this time around, I don't know if you can really see a difference in how, for example, the Fed would be behaving depending on who wins in November. I mean, they have signaled this low rate environment, for example, for the next a year and a half to 2 years. So that's not dependent, I believe, on who wins the election.
Sorry, next question. We're going to take a few more. What effect, if any, will the welcome and necessary surge of money into the hands of citizens and businesses have on the real estate market and the economy as a whole? Inflation a worry at all? Would real estate be a better investment than saving?
Yeah, so I think real estate, another reason why real estate comes out of this looking very good is you've had incredible volatility in the stock market, and you have this possibility of inflation. And for those of you that were here during the Great Recession, you remember we had the same discussion back then about the Fed printing money, putting it into the economy. Are we going to see a surge in inflation? And we have not at all seen that happen. And what's happened is banks have simply kept that money in excess reserves. So you just see this big increase in excess reserves. It hasn't been pumped into the economy, but problem is it could, right? So at some point, unspecified in the future, it could, and it should be an issue, but you kind of look at what's happened over the last 13, 14 years, and it hasn't happened yet. And even, Chairman Powell's been very clear, we'll worry about that later. It's much more important today that we prevent a crash landing of the overall economy. In addition, if and when inflation kicks back up, absolutely real assets are favored, right? And real estate looks much more, even more attractive than it would. So that's kind of how that looks. The traditional rules of economics have not applied recently, I guess I'll say, in terms of the money supply and inflation. But that money's got to get absorbed eventually, right?
Okay, we're going to take about 2 more questions. Reed is asking, should Congress make banks provide mortgage relief to multifamily and restaurant property owners?
I don't know. I don't know how to answer that. I'm not in Congress doing that. I do think more support is going to be needed after the end of July, just by looking at what's happening with the infection rates around the country and the increases that you're seeing that may partly be due to more testing, but it certainly is due to more people being out and about. And you see the pictures like I do. There are parts of the country, or even in California, where people, they're tired of it and they're rolling the dice, and going out. So I do think that we are going to see more support. I would like to see landlords treated equitably. I don't think it's fair that they are hit, and the people that rent from them are not. So just personally, I would be supportive of a more equitable lifeline, if you will, to that part of the economy.
Okay, and last question. Congress has reacted very quickly this time to curb financial damage with dollar backstops. What are potential impacts of the multiple trillions of dollars Congress has given us?
Yeah, well, I think we just talked about that, right? We talked about the inflationary potential of putting so much money into the economy, and that at some point it could very well be an issue. But when the economy, when demand is so constrained by, you saw the numbers on the job losses, you saw the drop in GDP. The decision that is being made today is that risk is worth taking in order to keep the economy supported until it can walk again on its own. So theoretically, you don't want to do that for a long period of time, but this is, everybody's a Keynesian in a foxhole, right? And here we are really in a situation where only the government can, provide the relief that is needed. So I don't want to downplay the risks, but just like the Fed chairman, I will say, until we are back on our feet, it's a secondary issue.
Wonderful. Well, we want to be super respectful of your time, and
Thank you, Mark.
Thank you so much. And I want to also thank Genevieve for putting this all together. She's done such a great job with all of our programs during all of this time.
Yeah, thank you.
And we're going to miss you next year. I know you're going to be around, but we'll look forward to seeing you.
I'll miss you too. I'll look forward to seeing what happens next.
Me too.
All right.
Good luck.
Thank you, everybody.
Thank you.
Thank you.
Thank you.
Bye-bye.